Let's move on now. As you know, there were certain amendments made in the finance bill a couple of days ago, and the country has now removed the long-term tax benefits for debt mutual funds. So India will tax investments in debt mutual funds as short-term capital gains. And as we know, mutual funds having less than 35% AUM in domestic equity will lose their indexation benefit. Now, what does this mean for the HNI and the ultra HNI category, and what happens with investments henceforth? Is this a really big setback, and how do they navigate in terms of investments? Rahul Jain, the president and head at Nuvama Wealth, and Nishant Agarwal, senior managing partner and head investment advisory at ASK Private Wealth, join us now to tell us what this means for the HNI and the ultra HNI category. Gentlemen, morning to both of you. Rahul, let me start with you first. If you can just, put on the table a broad understanding of what this means going forward, especially for a large chunk of the ultra HNI segment.
So what will happen, Sonia, is that earlier in the debt mutual fund side, used to get an indexation benefit, and your holding above 3 years used to get taxed at 20%. So if you look at a 7-year target maturity fund, generally they're in range of 7 to 10 years. The effective your tax rate used to come between 12 to 10.5 to 11%. That was the effective tax rate. But now with the amendment, this tax rate will become 30%. So effectively, your 18% of earnings will get more taxed, and that is why the yields on your debt mutual funds, etc., will go up by that amount. In terms of the yields will go down by that amount. So that is what has happened with the amendments coming in on the finance bill.
Okay, gentlemen, hi, good morning. What are we seeing now on the ground, Rahul and Nishant? Are we seeing, Nishant, if I can come to you, are we seeing lots of allocation into debt? Just a few days left, right, before the changes kick in. Are we seeing anything, large action?
Yes, absolutely. I think a good part which has been done in this budget is to grandfather. Two things is to grandfather existing investments for this financial year. So no investor needs to kind of rush and get out of the debt mutual funds to avail indexation benefit. What it also brings to the table is to invest debt money before 31st of March. Any investment which is made in this financial year, till the time it is held, will continue to avail indexation benefit and the advantages which indexation and long term follows. So we have seen a deluge of investors who were looking to invest in debt fund in the next 1, 2, 3 months are preponing their investment before 31st of March so that they can take this preferential tax regime by investing in the next 3-4 days.
Can you put any numbers to it? You called it a deluge, Nishant, but how large is it?
Tough from our side, but I would say on an average, if the clients were sitting on cash, 30 to 40% of money which was to go in debt in next 6 months is getting preponed and getting invested right now. This is also kind of supported by the fact that a lot of investors were invested in a category of investments called MLDs, or structured products, which also got negatively impacted in the budget, and many of those have been liquidated before 31st March. Unlike debt mutual fund, where current investments were grandfathered and do not get impacted, MLDs, there was a kind of a tax advantage which is only available if you redeem them before or transfer them before 31st of March. So both the things put together, investors who could sell their MLDs to gain tax advantage were sitting on liquidity. And if you make investment in debt mutual fund before 31st, you will get advantage in future, coincided together, and both these funds are now moving towards debt mutual funds.
Rahul, same kind of feedback from you as well in terms of what clients are doing?
Yeah. So there are two things which are happening, Prashant. One is that people are using this opportunity to increase the allocation on debt and go into debt mutual funds. Apart from that, I think the whole insurance change which has also happened in the finance bill, where the guaranteed plans earlier used to have no ticket size limit, now it is 5 lakh. A lot of money is going there as well, because that provides you still tax-free returns, and also you can lock in your future investments also on tax-free returns point of view. So a lot of allocation is going there as well. So both the investment platforms are getting a lot of client interest, and a lot of money is moving there right now. But we keep advising clients that since this change is happening, but you have to look at asset allocation and liquidity so that to ensure that you're just not running after because the efficiency of tax is going away. Because we strongly believe that asset allocation is first and that then later tax efficiency comes into play.
Got it, got it. So this is of course a time-bound thing. The money is rushing in right now before 31st March. But overall, if you look at asset allocation, Nishant, you're nodding, aggressively to that. So what is the asset allocation strategy now? Do you recommend at a time when equities has taken a bit of a backseat? Is there more money that you're recommending one puts into gold, into international funds, debt funds? What's the asset allocation strategy for the rest of the year?
So currently we are maintaining a neutral asset allocation between equity, debt and global. I don't think, like Rahul mentioned, we will be looking at changes in tax to alter asset allocation and move more towards debt or equity. That has to be aligned with the goals of the investors. And with the current juncture where market is, we don't see under or overvaluation in equity to move on one side or lean on one side. So we maintain neutral allocation based on the goals. Yeah.
Are you seeing a lot of money as well move into insurance products, similar to what Rahul was mentioning a while back? And can you quantify it for us? What kind of money are you looking at there?
On the insurance product, a little bit, yes, because there is another change in tax which happened in the budget, which said tax benefit of insurance beyond 5 lakhs of premium will not be available from policies taken from next year onwards. So these are little more longer term decisions. So investors who were on the fence, probably looking at deciding on insurance in the next couple of months, might be better off by deciding it now for large ticket sizes beyond 5 lakhs. And that is the main reason which we are seeing. Otherwise, just because of tax changes, making a new decision and investing, probably not as much. And mind you, the investment change primarily impacts insurance plans which were linked with insurance and investments together, whether it was endowment or whether it was ULIP plans, because normal term plan will definitely fall below 5 lakhs of annual premium and will continue to retain their benefit. So it's only when investments and insurance are merged together, those plans will lose the benefit.
Nishant, I'm assuming that the majority of the audience which is watching the program here, and I'm assuming you're, younger people, they say, well, you'll end up making more on equity in any case, right? So all this tax change on debt side, etc. Well, it's okay. Asset allocation is important, I think, as both of you mentioned. We're not seeing any, at least in the next couple of days and today, we're not seeing any rotation out of equities, rebalancing into debt, that kind of action. Nishant?
No, not at all at our end. As you very rightly said, over long periods of time on a nominal basis, equity would have given almost double the return of what debt has given. Equity, even if you look at index, Nifty, Sensex are 13 to 14%, debt is between 6 to 8%. So long-term benefits are right, but there is a reason why debt still exists in the portfolio. There are goals which people have to meet with debt. There is volatility which people don't want to take of equity. And hence there is a kind of an asset allocation decision which they broadly decide for the portfolio. That is not tinkering, neither are we advising to change that just because tax is changed.
Rahul, any other changes, interesting sort of products which people are reaching out for after these changes have been made?
So we will see, I would say, a renewed interest again going for bank deposits because that is what I feel next year will start happening, because it brings a lot of convenience, and since now that differentiation is reduced, I think it becomes a easy port of call for everyone. People might also go on buying direct bonds in cities, and I'm sure that they will assess the credit risk, but that is also one thing which will happen. I feel that ultra HNIs and HNIs will also move towards PMSs and AIFs, which can provide specialized strategies, higher yields for clients who are willing to take higher risk, will go into such strategies as well. So that is one thing which will happen for sure. So effectively, what we see is that the old money will keep sticking on debt mutual fund, because as we said that it will have some benefit there, but the new money flow in will start moving into these directions as well, where bank deposits, direct buying bonds of government bonds, NCDs of corporates, and also specialized strategies into AIF and PMSs will also happen.
Okay, wow, there has come a time when bank deposits have gotten more attractive than all other risky assets, right? Imagine the HNI and ultra HNI category taking their money and putting it into bank deposits.
I mean,
The very same place where our parents put all their money in, right? And we told them, no, you know what, bank deposit is not the place to be, equities is the place to be. But I guess everything comes back to security and safety at the end of the day.
Oh, absolutely. I mean, asset allocation, I think there is, you start there and then you move down to, individual asset classes, etc. It's just that, what constitutes and what makes sense in one particular category within the asset allocation, that perhaps has moved out a little bit, as both Nishant and Rahul pointed out. Debt mutual funds for further investments post the 31st of March now becoming very unattractive, at par with FDs. Well, time for a quick break now. Up next, Dheeraj Kumar Jain of India Pesticides will join in to talk about their new product getting